We are heading into the final session of today. We have a wonderful panel titled Central Banks and Macroeconomic Impacts of Climate Change and Ecosystem Degradation. My name is Elías Albagli. I'm the director of the Monetary Policy Division at the Central Bank of Chile. And I am very honored to share the stage with these distinguished speakers. I will introduce them in the order that they will be speaking. And the format will be the following. I will ask each of the speakers different sets of questions related to their areas of expertise, and then also a common question regarding the role of central banks. And then each will have roughly 20 minutes to discuss the questions that were asked. Please feel free to select, pick and choose. Think more as a broad range of questions that you can choose from as you please. Great. So let me start with Marshall. Marshall Burke is the Associate Professor of Global Environmental Policy in the Doerr School of Sustainability and Deputy Director at the Center on Food Security and the Environment, both at Stanford University. He's also a research fellow at the NBR. His research focuses on social and economic impacts of environmental change and on measuring and understanding economic livelihoods across the developing world. His work regularly appears in both economic and scientific journals, including Nature, Science, the QJE, and the Lancet, among others. He holds a PhD in agricultural and resource economics from UC Berkeley. He's also co-founder of Atlas AI, a startup using satellite and machine learning to measure livelihoods. Our second speaker is Douglas Arent. Doug is the Executive Director of Strategic Public-Private Partnerships at the National Renewable Energy Lab, as well as a Senior Associate with the CSIS Energy Security and Climate Change Program. Previously, he was the Director of the Joint Institute for Strategic Energy Analysis, also at NREL. He has a PhD from Princeton University and an MBA from Regis University. He specializes in strategic planning and financial analysis, clean energy technologies, energy and water issues, and international and governmental policies. And our third speaker will be Eduardo Cavallo, who is an economist from the International Development Bank in Washington. He holds a PhD in public policy from Harvard, and his research focuses on international finance and macroeconomics with an emphasis on Latin America. He has also worked on the Center for International Development at the Federal Reserve in Atlanta and at the John F. Kennedy School of Government, among others. Great, so let's get down to business. I'll start with Marshall. Many countries worldwide are already facing dire physical impacts associated with climate change. And as we've heard here today, we expect this to intensify in the near future. Given your broad expertise on the physical impacts of climate change, I would like to ask your perspective on a couple of issues. First, what do you think are the main threats that climate change and environmental degradation poses around the world in the short, medium, and long run? So here I'm thinking about the expertise on estimating and understanding damage functions. So what do you see are the main channels through which climate change or other environmental stressor will hurt our economies? And how do you think will be the regional distribution of these effects? Second, what are the channels through which climate change and the loss of ecosystem services will affect relevant macroeconomic variables, such as the one that central banks usually follow: inflationary pressures, investment, interest rates, long-term growth, etc. And what do you expect the macroeconomic consequences of climate change and environmental degradation to be on these variables? Then the common question that I'll ask for all of you, and please only answer if you have time in the end, but I would be very interested, I think all of us will be very interested in hear your thoughts on this. What do you think is the role that central banks can play to contribute to speeding up the transition and to get a better understanding of both the physical and the transition impacts of climate change and environmental degradation? So please, Marshall.
Great. Thanks a lot, Elias. It's great to be here. Thanks again to the Central Bank for hosting this great event. I've already learned a lot. So I am not a central banker. So I'm going to have you answer that question, and folks in the audience answer that question. What I'm able to do and what I study is the impacts of physical risk on a range of socioeconomic outcomes that we care about. And actually don't actually like the term physical risk because I think it doesn't really focus us on what's happening. These are not just physical risks, they are economic risks and social risks, and decades of work have now really demonstrated how deep the risks of a changing climate and a changing environment go for a range of socioeconomic outcomes that we care about. So I think we shouldn't even call them physical risks, I think we should call them economic and social risks just to really bring that home. So what are those risks? We'll hear more about this tomorrow, and I will not use my full 20 minutes today because I have the mic for a little bit tomorrow as well to go through some of my own research. So let me just give a broad overview now, and you'll hear from multiple speakers on this tomorrow. So let me divide the risks into two broad categories. One are, let's call them the TV risks. These are the charismatic, the iconic risks that we see on TV when a TV commentator wants to talk about climate change. These are floods, these are hurricanes, they are increasingly wildfires, both where I live in California, and increasingly here in Chile, I gather. Wildfire activity has accelerated dramatically. And these are charismatic. You can take pictures of them, and they're also important. They cause large impacts. It's important to note that these things exist without climate change, of course. They've been happening for as long as we know of. Climate change is a thumb on the scale of these physical risks, making them more likely and more intense. And these charismatic risks, so again, hurricanes, floods, wildfires, are certainly an important part of the puzzle. And their direct impacts are often what people think about when we think about climate damages or climate risks. But they are actually not what worry me the most. I think what worries me the most is the stuff that's less obvious, the stuff that's harder to put on TV. And these are often, there's some direct losses, but often the indirect, lower intensity but much more widespread losses that we get when we get climate change or environmental change. Today, or right now, I'll really focus on the climate part of this. So if you think about extreme heat and what we've learned about extreme heat, and this doesn't even have to be an insane heat wave, even mildly warmer temperatures, we're understanding a lot more about what that does to a range of outcomes that we care about. Agricultural productivity is probably the best studied. We know that agricultural productivity of most crops that we care about declines when it gets hotter and declines substantially the hotter it gets. Mortality, similarly, we see mortality increase not just at extremely hot temperatures, but at mildly hot temperatures. Morbidity, too. More people show up at the hospital, even if they don't die, on reasonably hot days. And so I think we've understand those sort of broad categories for a while now. Just in the last 5 years, I would say we are learning more about categories where we didn't necessarily expect there to be impacts. So one is very large impacts on labor productivity. So we see both in experimental studies, and this is one setting where you can actually run experiments. We can put people in hot rooms. We can have them do a task. It can be a menial task, sorting things into boxes. It can be a computational task on the computer. Across all of those tasks, if you turn up the heat in the room, people are less productive at those tasks. And not only is their labor less productive, they are cognitively less sharp. And again, you can see this in experiments when you crank up the temperature. You can also see it in test scores. So if you look at kids who take a test on a hot day versus a not hot day, the hot day test takers do substantially worse on the test, right? And so this now is important when we think about broader economic aggregates. If we think cognition is important in the creation of ideas, this could be one channel through which warming temperatures might affect the creation of ideas and thus potentially longer-term growth. And I'll talk more about that in a second. So these sort of smaller, more insidious effects of even mildly warmer temperatures, they affect so many of us, right? So it's not just a flood hits one county or a hurricane hits one state. These are very, very widely shared and shared globally in a way that really amplifies impact. One thing I didn't mention is sea level rise. So a thing you often see on TV or in media coverage of climate change is sea level rise. Sea level rise will be important, but as an economic impact, it's very unlikely to be substantially important relative to these other threats, at least for the next century or two. So we talk a lot about sea level rise. I have a lot of climate science colleagues who spend their entire career thinking about sea level rise. To me, this is not a first-order impact that we should be worried about in most parts of the world for the next century or two. Now, there are some low-lying areas where obviously that's not the case, where sea level rise is existential, so this is not a blanket statement around the world, but for most places in the world, sea level rise is not going to be the most important threat. Okay, so it's these insidious indirect effects, which I think research is increasingly showing is likely the dominant economic impacts of a warming climate. And I hope we are attentive to these. So let me then pivot, and I will, as I said, finish quickly and hopefully leave time for more discussion and try to answer your second question on macroeconomic implications. And let me focus on 4 areas where I think we have parts of a story or sort of emerging evidence, but I think where we need likely a lot more work. So first is inflation, interest rates, asset markets, and then finally growth. And I'll talk more about growth. I'll bore you with some empirical research on growth tomorrow, so I won't spend much time on that today. So on inflation, my best read of the evidence is our biggest worry is on food. So again, there's a very tight link between a warming climate and lower agricultural productivity. And as we get more and more correlated climate shocks where you get droughts or heat waves and bread baskets at the same time around the world, which we have seen in recent years, you're likely to see declining productivity and increasing prices. And again, we've witnessed this in the last decade. Again, these correlated shocks across important global bread baskets. So I think on the inflation side, again, the main worry is going to be on food prices. I think overall we should expect the level to go up and the volatility to increase. I think that's where the signal is strongest. I think for other commodities, we have less evidence, and science right now has less to say on prices or on inflation worries. So that was quickly on inflation. Number 2, on interest rates. So again, emerging area of work. I think science is starting to show that at multiple scales, lenders are starting to be more aware of these physical risks and are starting to, I would say, price them more aggressively. We see this at the firm level, and we're starting to see evidence, I think, at a more macro level, at a country level. There's a great paper in the last year by some researchers at the SF Fed that looked at corporate borrowers following a hurricane. And they found that loan spreads or interest rates for corporate borrowers went up after hurricanes. You might think, okay, that's obvious. Hurricane comes in, destroys capital, firms are in bad shape. It's going to cost them more to borrow. What the researchers looked at was not only the firms that were affected, but nearby firms who were in the area of the hurricane but not actually exposed to the hurricane, right, who didn't themselves suffer damage. And what they show, I think, pretty convincingly is lenders' awareness about the damage that hurricanes can cause had gone up, and that they were, in a sense, penalizing anyone who was in the area of a hurricane for that event. So again, firm-level evidence that climate risk is now being priced into, in this case, loan spreads. We're seeing, I would say, emerging evidence of this at the country level. Again, both on hurricanes, and I have a student actually working on this, tropical cyclones, hurricanes. We call them hurricanes. Elsewhere in the world, they call them tropical cyclones or typhoons in the Pacific. Actually, don't know what you guys call them. Do you guys call them? Doesn't matter. Emerging evidence that you get hit by a large tropical cyclone, it can depress economic activity for years, and this can increase debt to GDP ratios, increase debt stress for countries, and potentially, again, raise interest rates, raise cost of borrowing on international capital markets. I would say, again, emerging evidence on that, but not fully established. My last two, so third on asset markets, and Ton Phan, the discussant, I think put it nicely. The jargon is repricing events. So what happens when an asset market, and here a lot of the focus has been on residential real estate markets. Again, much of the evidence in the U.S., at least that I know best. So I'll repeat Jim's apology. I'm an American, and so we talk about America all the time. It's embarrassing, but I'm going to do it. So what we've seen in residential markets in the U.S. is that they actually are not that efficiently pricing climate information, but suddenly a hurricane will happen or new information will be revealed and prices can change pretty quickly. So they are not sort of slowly incorporating increasing flood risk into prices, but when given that information, again, they can adjust quickly. And so these repricing events could be, I think, a concern for price stability. Last one is on long-term growth. Again, I will talk about this tomorrow and show some evidence. I think multiple teams of researchers, including mine, has shown that various climatic events, warmer temperatures, hurricanes, can cause persistent impacts on aggregate output around the world. And this is not just in the tropics or in lower income countries. We see this in high income countries as well. So I think there is a substantial output risk, whether it's a level effect or a growth effect is something we can argue about tomorrow. But we see effects in the data. We see persistent effects on output of climate shocks. And that, to me, sounds like something a central bank might be interested in. So I'll hand it off.
Excellent. Thank you very much for that. I'm sure there will be lots of questions related to it. I have a couple of my own, but I'll wait for the end. Let me turn to Doug. Economies worldwide are accelerating the decarbonization process by implementing mitigation policies, such as carbon taxes and adoption of cleaner technologies. The impact of such transition is expected to be heterogeneous among industries and firms, with potential aggregate effects depending on the role that the target firms play in the economy. Given your broad expertise on energy, green technologies, I would like to ask you a couple of questions. First, what do you think are the best current available technologies to enhance the energy transition? What are the new technologies that are most promising to be developed, in other words? Second, could you elaborate a little bit on just the magnitude of the investment needed in both mitigation, meaning the transformation of the energy matrix worldwide, but also adaptation to increasing physical damages from climate change? Do you see them as macroeconomic meaningful with potential impacts on, say, investment rates, interest rates? And third, what are the opportunities in terms of economic growth that the implementation of such technologies could produce? And particularly here, if you could refer to the heterogeneity in terms of which are the countries best positioned in this energy technological transition. And of course, if you have some time and you want to elaborate on the central bank question, please, welcome.
Okay, thank you very much. So it's really a pleasure to be here. Let me offer a couple other background perspectives of why I might be sitting here. One was I actually gave a talk to the Bank of International Settlements Green Swan policy dialogue earlier this year. That was one. The second one was I was actually a coordinating lead author of Working Group 2 on economic impacts of climate change during AR5. I've also worked in the energy economic ecosystem modeling world for about 25 years or so. So I might sparse in a few comments on modeling and where that might be able to go, particularly in that last session question. So let me go order by order. So I have 4 topics to run through, and I'm going to do them without the benefit of a set of slides, which is a good challenge and also a deep challenge to try to articulate what we know today about energy technologies and the energy transition, and frankly, what we don't know as well in terms of some of the challenges. So energy modeling today in the kind of energy transition world is very explicit, a little bit like the ecosystem services. It is spatially explicit, it is temporally explicit, and it is very data intensive. So we, for example, run a 44 petaflop supercomputer to do energy models, particularly of power systems. We have embedded deep power systems modeling into CGE models and embedded those then into integrated assessment models. And so we are able to actually dive down, both spatially and temporally, and raise that up either stylistically or otherwise into what I hope are meaningful macroeconomic tools that can be valuable for policymaking. I'd say one other piece on that front, which I think is really important, it's kind of at the cusp of modeling, and it blends the understanding the impacts of ecosystem services, which today we're looking at historical changes and historical impacts of social and economic risks derived from maybe physical impacts. And we're actually able to now use deep artificial neural network models to actually look at forward climate model projections and downscale those both temporally and spatially so that we can look at future pixels under RCP scenarios, radiative concentrated pathway scenarios, climate change scenarios, and ensembles of those scenarios, because we can run those in literally minutes for the whole world, because they are super smart models and they've been trained very, very well. That has an incredible implication for, I'm going to come back at the last question. But to your point on then technologies, so I would say most folks are probably sitting in their seat thinking, he's going to say wind, he's going to say solar, he's going to say batteries, he's going to say electric vehicles, all great. Yes, those are individual technologies, but the core strategic thing that I would like you to take away is that the energy system is increasingly interconnected system of systems. And as we transition to a decarbonized energy system, whether or not that's here in Chile, South America, Latin America, or the world, it is a clean energy economy based upon a clean power backbone, clean power, and I don't use just renewables there, because it could include carbon capture and storage, which could go back to the natural gas story that was told earlier, that it wasn't exactly 100% of all the story in the United States, but close enough. But it's clean electrons increasingly used throughout the economy for mobility, holding a conference like this in a building, and then secondly, power to chemicals and fuels. So this is the important second part of the transition that has the real opportunity. And okay, so what does that translate to in your language? You hear a lot of hype about hydrogen. And there's even a hydrogen strategy here, there's one in India, etc. Okay, hydrogen is the use of clean power to a chemical. Hydrogen may not be the end chemical. It may be hydrogen combined with carbon to make methane, CH4, right? It might be hydrogen combined with nitrogen, which you can get out of the air, to make ammonia, which is the fundamental building block for agricultural fertilizers, etc. So that pathway of clean power for use in the economy directly or use through chemicals and fuels is increasingly interconnected. The other way to think about it from an economic perspective, it's increasingly codependency risk across sectors. And so that has two implications. First off, you have to think solution-wide for the economy. Secondly, you have to understand and build in resiliency. And this will come back to the third question where you've asked me about adaptation and mitigation together, and I'll come back to this point at that point in time. The third element of strategy is circularity. I had a conversation at lunch today, basically asking the question, what would be interesting to learn from an energy nerd sitting in a conference for a central bank? And it's really about understanding how will all this infrastructure build out, and frankly, what it would be the role of a central bank in supporting that. And the real point is that there are roadmaps, I use the term, and it's very broadly, to be able to get to this energy transition by putting in the appropriate electric vehicle charging infrastructure, building out industries of the future, which include recycling, repurposing, and reuse industries. And so the question at lunch was about, what about batteries? Aren't they just going to be dead bricks in 20 or 30 years? And the answer is no, because the scientists are already working on recycling, repurposing, et cetera. This is part of the destructive creativity that was talked about just after lunch, which is we must be investing in future industries which are compatible with a sustainable future. And so that's got implications there on the policy front. So let me go to the second question in terms of scale of investment. So roughly new investment in the energy sector last year was give or take $2 trillion, roughly. The International Energy Agency projects in order to get onto and stay on a net zero pathway, that investment must increase to about $4.5 trillion, $5 trillion per year globally. Many countries have their net zero roadmap. There's one produced for Chile. There's an action plan for decarbonization that we helped the Chilean ministry with. That's publicly available. I can send a link around to that, and many others. And so that's the scale of just the energy sector itself and the new investment in just energy. But I want to make another point which I think is not quite as appreciated as it should be, which is in most developed, fully electrified economies like here, the United States, Europe, many, many others, expenditure on energy is actually a very small part of GDP, 3.5%, 5%, maybe 7% or something like that. However, the full economy, 99.9% of that economy, including all of its macroeconomic stability, relies upon reliable, secure delivery of energy, a la Russia's energy war on Ukraine and Europe, etc. So I think from a central banking perspective, it perhaps is not well captured in the economic models what the full risk profile of disruptions to an energy supply chain mean, and therefore what it means to invest in resilient energy systems. And I would welcome conversation over cocktails and dinner about that one. The third piece that you asked me about was kind of implications. And there are two trends that I'll just mention here very quickly. The first is that there is the opportunity, and frankly, there's a policy orientation, shall I say, developed in the last 3 years predominantly, that the energy transition is an enabler for domestic energy security and domestic energy productivity in a way that it never was. It was believed under the globalization paradigm that free flow of energy and markets would allow economic productivity to take place globally at the opportunity of the ability to pay. And that's no longer the case a la the most recent war and frankly the reset of geopolitical tensions around, I'll call it strategic alliances and strategic allies. And thus there's also the perspective and the opportunity to rethink, particularly I'll call it domestic central banking policy, of how does one support the stability of a clean energy transition and a clean energy supply chain. And so that means, for example, up-leveling or upping the value add of minerals and extractives in every economy, particularly here with the intense minerals mining in the north, or utilizing natural resources within their socio-political acceptability. And I use that latter phrase very carefully because it may be that the bigger challenges to developing or transitioning to a clean energy economy are about the social inclusiveness processes and getting to yes, having people be part of that inclusive transition. So we can talk about energy just transitions and things like that if you'd like to as well. So that's one point. The second point that you asked about in terms of, I'll call it country positioning, is really that every country that I travel to, and I travel to more than 40 or 50 in a given year, are trying to position themselves to be the leader in the low-carbon green energy economy. And with a, if I may use an impolite term, a relatively naive approach toward the geopolitical and competition for clean energy-derived exports. And here I think of energy specifically. That is clean power to hydrogen that may go to methanol or ammonia or natural gas. Thinking about transferring clean derived fuels that are produced here, for example, and competing with any other country to supply Singapore or Taiwan or Japan. Every country that has a big endowment of clean energy resources is on the exact same strategy. And therefore, the real question is there any differentiation? And is there strategic differentiation in an export competitive market versus supporting your domestic economic productivity with less dependence upon exports on that front? And so the point there is really thinking quite deeply about energy interdependencies on all that. And so let me come to the last point, and I apologize, I'm pretty close to time. The role of central banks. I mentioned a couple of them. The first off is to recognize the interdependencies among sectors, and particularly for energy and an economy. And then the second piece, I believe, is very critical, which is to understand that mitigation and adaptation are not two separate sectors. They're not two separate strategies. They must be built together into a resiliency policy, which means that the bank should be considering deeply what is the policy for lending for resilient infrastructure. Resilient infrastructure means adjusting for pricing risk, physical, social, economic risk, and therefore pricing resiliency. That's a policy question for a central bank, I believe, but you guys you can answer that one. The second one, I believe, is really, really important, and you've heard slightly different perspectives on different modeling capabilities today. There's the macroeconomic modeling, there's the social economic risk modeling, there's the ecosystem services modeling. We've got very, very deep energy system modeling, energy connected to water, food, and infrastructure, as well as future climate. I believe that there's a very important role for central banks to step up and ask and support the modeling community to come together to help improve the modeling fidelity that can help with policy making at the central banking level, as well as many other banking and financial decisions as well. So I'll stop there and welcome questions.
Thanks so much, Doug, for those insightful comments. Let me turn to Eduardo. We've heard from Marshall about physical impacts. Actually, you use a different term, but socioeconomic impacts?
Perfect.
Of environmental degradation. And Doug told us about energy technologies or building resilience, will be more appropriate, that are key to achieve the green transition successfully. Given your broad expertise on the economic impact of natural disasters and being part of a multilateral institution, such as the Inter-American Development Bank, I would like to ask you thoughts on the following issues. First, do you expect to see any significant impacts from global warming and the more frequent and intense extreme weather events on the trend of GDP on specific industries and economic sectors, in particular in Latin America? And do you expect to see this, or do you see this issue as a rather long-term problem, say end of the century, as we've seen in many of the graphs and the modeling that we've seen today, or is it more of a short, medium-term problem, say the next 10 years? So that's one question. Second, do you expect the changes in public policy in Latin America countries consistent with the climate transition to have positive or negative effects on key macroeconomic variables with respect to the current levels? And in particular, what do you see as the main challenges to overcome in order to make these changes politically feasible in the short term? What's your view also about the transfer mechanisms between advanced and emerging market economies to accelerate the green transition in the latter? I know there's a lot of questions, but again, you can choose, pick and choose the ones you...
Thank you, Elías. I begin by apologizing. My voice is taken today, so I'll try to make it through the 20 minutes, but bear with me. First and foremost, thank you very much to the Central Bank of Chile for organizing this fantastic conference, not only in terms of the quality of the discussions and the presentations, also in all the informal, we've all talked about the interesting lunch conversations we had and so on. So thank you for the Central Bank for doing this. It's really very interesting. And I thank you for including me in this panel. So I am from Latin America. You can probably tell by my accent, so I'll try to make up for the American perspective so far. So I'll introduce some examples and some issues idiosyncratic to Latin America and the Caribbean. And let me start by saying that when it comes to climate change, few regions in the world are as critical to our shared global future as Latin America and the Caribbean. So let me give you two examples. One is the Amazon rainforest. It spreads across 8 countries and captures about 1/4 of all of the carbon dioxide absorbed by the entire planet, helping to mitigate climate change for the whole world. The second example I want to introduce has already been mentioned, the issue of food security. So Latin America is a leading world exporter of food. We produce enough food to feed about 1.3 billion people in the world. I mean, and if the right reforms are implemented, that number could go up. So, when it comes to climate change, these examples show that we have a role to play. We have a dimension in which it's very important that Latin America becomes a strong player. For example, if we don't protect the Amazon, we will severely reduce the capacity as a whole to meet Paris climate targets and limit warming. If we don't tackle climate change, with the increased incidence of disasters, extreme weather events, loss of biodiversity, loss of agricultural productivity, the issue of food security, which I gave as an example, would come to the fore. So Latin America has a role to play here. Let me step back 1 second and talk about the global challenge first. We don't need to motivate this very much in this audience, but it's clear that global temperatures have been on a consistent rise since the early 20th century. So scientists compute this global temperature anomaly, which is basically the difference between the annual mean temperature and the average temperature over the last century. That has been on an upward trajectory, which has accelerated after the mid-70s. And today, we are about 1 degree Celsius, we are already about 1 degree Celsius above the century's average. To come sort of closer to the most recent period, if you take the period between 2015 and 2022, 7 of those years have been the hottest years in recorded history. And this year, again, in 2023, we have already set another record. So, you know, among the so-called natural disasters, which is an area, as Elías was mentioning, in which I have done some research, you know, some of those so-called natural disasters are directly influenced by climate change, while others are not. So, you know, meteorological events, for example, that encompass things like extreme temperatures and storm have seen a 7-fold increase in incidence since the 1970s. Hydrological episodes like landslides and floods have multiplied 6 times since the 1970s. And climatological disasters like wildfires and droughts have also increased by a factor of 6. You know, some skeptical people say, well, you know, that may just be better recording, no? Well, there are natural disasters that are completely unrelated to climate change. For example, earthquakes, which unfortunately here in Chile you also have experience with. Well, the incidence of those hasn't changed much over time. So it cannot just be just better recording. There's clearly a link over there. You know, unfortunately, things are likely to get worse before they get better. Elías was mentioning in one of the questions he made earlier today about these shared socioeconomic pathways, which are a set of narratives and quantitative projections developed by a broad collaboration of researchers or as part of the climate change research community that describe different future socioeconomic developments and their implications for climate change mitigation and adaptation. All these narratives differ in terms of the projected population growth, the economic development, technological progress, environmental protection, globalization, among other factors. Now, there are 5 main SSP, shared socioeconomic pathway scenarios or narratives. Only one of them is compatible with the Paris Agreement goals. That's the sustainability scenario. And, you know, under all of the SSP scenarios except scenario 1, which is the one compatible with the Paris Agreement goals, the projected global annual anomalies will continue to rise over time. So that's why I'm saying that things are likely to become worse before they get better. What this suggests to us is that urgent action under the Paris Agreement is needed to avoid the worst effects of climate change. As you all know, the Paris Agreement relies on the so-called national determined contributions, NDCs, as the main vehicle for driving climate action and increasing global ambition over time. You know, effectively implemented NDCs, therefore, are critical to achieving the agreement's goal. But on this front, we don't have very good news either, because according to the UN's emission gap report, total global greenhouse gas emissions in 2030 are estimated to be around 58 gigatons of carbon equivalent based on the implementation of the current NDCs. This level of emissions is about twice what is needed for the Paris Agreement goals. So there is a large emission gap between where emissions are heading with the current NDCs and where they need to be. So achieving the Paris goals will likely require most countries, including countries in Latin America, to update their NDCs with more ambitious targets and implement policies in that direction. Now, what does this all mean for Latin America and the Caribbean? Let me start by saying that Latin America and the Caribbean is unique on a set of dimensions. It's It's the region with the highest level of urbanization in the world, or at least among the highest level of urbanization in the world. It's clearly a disaster-prone region. Think, for example, of the vulnerable, particularly the vulnerable countries, particularly, for example, in the Caribbean and the Central American region. It's also the region, as I said at the beginning, which is home to the Amazon and other biodiversity hotspots. It has a relatively clean electricity generating matrix compared to the rest of the world. That's because of the high incidence of hydro in the energy generation, and also solar and wind and so on. So we are starting from a relatively clean electricity generating matrix. But we are a major source of forest carbon emissions. The high rates of deforestation in the Amazon threaten to transform one of the largest global carbon sinks into one of the largest sources of emissions, with many areas in the Amazon already emitting more carbon than what they capture. So while Latin America is unique on many dimensions, Latin America and the Caribbean also faces some specific challenges. We have very high levels of poverty and inequality. Indigenous and Afro-descendants people are highly vulnerable to climate change. We have groups with vested interest in the status quo. Of course, while interest groups are not unique to Latin America, characteristics of the Latin American politics, and going here to address one of Elías' questions, characteristics of the Latin American politics tend to amplify their influence and make reform harder compared to other contexts. For example, regulatory capture and weak institutions in general in the region mean that environmental agencies here are less able to implement climate policies that are opposed by powerful business interests compared to agencies in advanced economies. So overcoming these challenges will require a lot of political will and tailored strategies. Among the challenges that we have as a region, we are a region of low growth. We have been growing very slowly for decades now, and we have very high fiscal vulnerabilities, so that makes the implementation of solutions challenging also from the fiscal standpoint. And of course, we have many competing and urgent development challenges. So it's challenging for the region given the unique characteristics and also given the unique challenges that the region faces. Let me discuss some recent estimates on the impact of climate change and disasters in Latin America and the Caribbean specifically to provide some examples in the region. So a very well-known study by Marshall here and co-authors, they'll probably present some stuff about that tomorrow, shows that the effect of rising temperatures differs for countries with different climates because economic growth rates respond non-linearly to rising temperatures. Well, at the IDB, we have done work extending the Burke et al. Paper in terms of the number of countries in the region that are included in the sample and also in terms of the period covered. The results, I was telling Marshall before, it's very similar to his, and the point I want to make here is that for all the countries that are included for all the Latin American countries that are included in the sample, except for Chile, all of the countries in the region are already located on the declining portion of the curve, meaning that higher temperatures from here on will result, according to these estimates, on lower GDP growth. And that's because we are a region of high average temperatures to begin with. Similarly, estimates show that total annual rainfall has a non-linear effect on economic growth. So, for example, the increase in the number of wet days and extreme daily rainfall have negative effects on economic growth rates that can be quite persistent over time. There are also changes in the distribution of temperature that go beyond changes to the mean annual temperature. So climate change is expected to increase the mean and also increase the variance of the temperature distribution, leading to greater dispersion in the distribution. Together, these changes will substantially increase the number of days of extreme heat. And for the reasons that Marshall was commenting, this has negative effect it's likely to have negative effects on economic growth for exactly the reasons that he was mentioning. So climate change is also expected to increase the frequency and intensity of climate-related disasters. So at the IDB, we have studied the economic impact of storms. So again, I'm not going to enter into all of the details here, but one interesting thing that we find is that the estimated impact of the most severe storms, think of hurricanes, for example, is about a 2% decline on GDP per capita growth in Latin America. And this sort of headline figure is similar to the one that is found for the global sample. But one interesting feature is that while the severity of the negative impacts of these storms on economic growth generally diminishes as you include less intense storms in the global sample in the world, the same pattern is not true or is not observed in the sample of only Latin American and the Caribbean countries. In Latin America and the Caribbean, the negative impact of storms on economic growth are estimated to remain about the same across varying intensities of storms. So, if we think for a second about that, what this suggests is that in Latin America and the Caribbean, the frequency of occurrence of this type of events, and not just the intensity of the storms, matters for economic outcomes. And in the era of climate change, this is a worrisome development because both the intensity and frequency of storms are expected to increase, and therefore countries in the region could suffer even worse impacts than the rest of the world. Let me say just a couple of more things about the estimates. I'm cognizant of time. I think we're running low, so I'll end, and then we can come back with some things in the Q&A. But what explains the decline in GDP per capita growth that we observe in Latin America and the Caribbean? So we have studied this both from the demand side perspective and the supply side perspective. On the demand side, what we see is that there is usually a fall in consumption. This is important because consumption is tied to welfare, and a decline in exports in the aftermath of these types of events. This is partially offset by a rise in government spending, and an interesting result is that while consumption and export growth eventually revert back to the mean, government spending growth remains positive on average for several years after the storm. So this will have fiscal implications that I'm going to comment in a second, and I'm going to end with that. But before that, on the supply side, we find that the main negative impacts come from negative implications on TFP growth. So on average, the growth rates of capital per worker and labor force participation remain broadly unchanged in the aftermath of this type of disasters on average. But, TFP tends to fall. So this suggests that this time of extreme weather events have estimated negative economic impacts that come mainly through the misallocation of productive resources. The negative impacts of climate change that I have discussed in the region are exacerbated for poorer countries, and within countries for the poor and most vulnerable populations, because they are less prepared to deal with that. So let me stop here because I've already run over 20 minutes and leave some time for the discussion, and I'll come back to some of the other stuff I have prepared if there's time. I apologize for that.
Excellent. Don't worry. So before taking the questions from the floor, I would like to ask each of the panelists one very quick question in reaction to the comments you made. And here I'm thinking about setting the stage for tomorrow's first session, which is about financial risks. And I like the distinction you made. I also don't like the way we call climate risks to everything, but for a different reason. My reason is that we call climate risks things that are actually in the baseline. And that the danger of that is that we don't think enough about what the actual risks are, that the things that are not in the baseline. So I would like to ask each of you, related to your comments, a question about what I see as true climate risks. So let me start with you, Marshall. You described trends, climate impacts that are more chronic in nature, perhaps. What is your view on this emerging literature on tipping points? In particular, I read a paper that came in, I think, in Nature, maybe a couple of months ago, that significantly brings forward the possible date of the slowdown or even collapse of the Atlantic Meridional Ocean circulation, which would be a huge tipping point, of course. So in your reading of the literature, are you worried about these tipping points?
I think we can distinguish maybe loosely two types of tipping points. One is the climatic, those tipping points in the climate system, which I think is maybe what you're referring to. The other that people have thought about is tipping points in social systems. So is there some climate threshold that you pass that tips a social system into a different equilibrium? My read of the literature is still that we don't have a good sense of exactly where those tipping points might be. From a risk and uncertainty perspective, they seem really important. And almost surely the fact that there's a non-zero chance they exist means we should be more aggressive on mitigation, just from an uncertainty perspective. But my view, reading the literature, is on both the climate tipping points and the social tipping points, is the literature does not have much to say in a precise way on if and where those tipping points exist. They could exist, and we should take that seriously, though.
Thank you. Doug, I really enjoyed I thought very interesting the point of building resilience into the energy matrix. And as I was listening to you, I couldn't help remembering this book about Kim Stanley Robinson, The Ministry of the Future, which I'm probably you're familiar with, which starts chapter 1, I think, with a massive heat wave in India, I believe. And everybody turns on the AC at the same time, and the grid collapses, going back to your building resilience. So people have nowhere to run, and they go to the lakes and whatnot, but I think in the end, 20 million people die in one day. So that sets the stage for the rest of the book, which I strongly recommend. It's, it's quite a trip. Given that, in your words, you are an energy nerd that knows about these issues. What is your view on the actual probability of events like that occurring as heat waves become more frequent, in particular in humid countries?
Yeah, let me try to do a quick answer. So they already occur. Maybe not that exact one, but for example, I believe Brazil's power system was completely blacked out, or most of the country, for 9 hours in August, if I remember correctly. That was due to, 1, intense demand, and 2, lack of hydro resources. The hydro resources were from long-term drought. If that long-term drought is in your baseline, then I think we need to rethink what normalization of baselines is. That's one thing. The second thing is there are at least 2 good examples from the United States, actually, in cold weather climates, or the cold of a hot weather climate. So think Texas. The 2 big events there were actually cold weather related, because it both increased demand considerably, this is for heat, But also what happened eventually, when you look at the numbers, was it stopped the production and the delivery of natural gas in the power system. And so gas was unable to produce as the flexible resource there, which not very many people understood the dependency on natural gas. So having fossil fuel in your system is not a guarantee. Let's just put it that way. The third piece, and let me just lay out where there's a solution, which is that in that situation in India, if those air conditioners had been smart, i.e. controllable by the system operator, then one could think of flexibly managing them so they didn't all turn on at once and the system could actually respond to the increased needs or the increased need for coolness, not just for turning on an air conditioner, but for coolness, which our body has a temperature range to deal with, right? The air conditioner might be set at 18 Celsius, but our body can comfortably deal up to 24. And so if we had smart thermostats and smart controls, we could likely avoid that. That is an investment policy decision that is very similar to electric vehicle charging and other things. So is it a possibility? Yes. Is it avoidable? Yes.
Excellent. Eduardo, coming from Latin America, we cannot finish this talk without talking about debt, I think.
Yes.
And I also thought that you set yourself on this course, my friend, because you made a lot of emphasis on the increase in the frequency of weather events in an already disaster-prone region. And each time one of these events come, they leave quite a tally for the government. So do you see a significant risk, financial risk, coming from an increase in debt in Latin American countries that maybe is not yet accounted for in the official projections?
Mm-hmm. Yes. So let me start answering your question, taking the opportunity to make a little bit of shameless propaganda about something we are doing at the IDB, which is next year. As the IDB, the flagship publication of the IDB it's a series called Development in the Americas. Every year is on a different topic. The reason I'm sitting here is because I'm co-editing the one that's going to come out next year, which will focus on climate change and disasters, of course, taking a view of the region. And in that context, some of the results I discussed are going to be presented in this report. And we have also looked at the issue of debt. So your question is perfect in the sense that it allows me to go back to something I said during the presentation and I didn't fully wrap, which is the fact that we observe in the aftermath of these extreme weather events an increase in government spending. We usually also increase a decline. We also typically see a decline in government revenues, by the way, which in the end translate into an increase in indebtedness. So we have looked, for example, at the experience of countries in the Caribbean basin, and we have done some counterfactual analysis of where we have looked at what has happened to indebtedness in the region in the aftermath of the impact of, say, very severe hurricanes. And we have sort of seen where that ended and what it would have been based on a counterfactual analysis in the absence of disasters. And this is important because not only does the level of indebtedness go up, I'm going to share the results in a second, but also financial conditions usually worsen when these disasters strike. So we do not live in the kind of frictionless financial markets in which when you are hit by a negative shock, you can go out and borrow to smooth consumption, I mean, the cost of borrowing usually goes up in the aftermath of these severe negative storms. So we have an increase in the deficit and a higher financing cost. So, well, in the Caribbean basin, what we observe is that when you look at the trajectory of debt accumulation in the aftermath of disasters, there's an increase in the trend level of indebtedness that's on average about 10%. And 3 years after the onset of significant storms, debt levels are on average about 20% higher than what they would have been in the absence of some of these. So yes, I think that we are not taking into account the fiscal implications of these type of episodes, and many of the projections that we have are too optimistic in terms of assuming that these things are not going to happen. Well, the experience of the Caribbean, at least in the way we have studied it, shows that this will have very strong negative implications, and this is something that we should worry about. I mean, if we have more time later on, we can discuss what we can do about that. I think that in Latin America, one issue that we have is that insurance markets are not well developed, so we need to find ways to strengthen catastrophic risk insurance markets to try to improve the ability of governments to insure for some of these risks, but that's for a longer answer than the time I have, so I leave it here.
Excellent. So we have some time for questions from the audience. I see Gonzalo.
Hi. Sorry. So I think this is going to be related to what we are going to talk tomorrow in tomorrow's sessions. So I'm thinking about the social cost of carbon, and we want to, and all these damage functions and the modeling that we do. A good part of that is to try to calculate the social cost of carbon, right? The EMs, the ultimate goal of EMs is to get a number of how much we are willing to pay in order to reduce 1 ton of CO2 from the atmosphere, right? But there is a lot of heterogeneity behind the social cost of carbon, right? So this morning we talk about a spatial heterogeneity. So there are going to be countries that are going to be even benefited from the global warming, right? Cold countries that today are rich countries, while we are also going to see maybe tropical countries that are going to be or are going to face huge damages. And at the same time, also we, Eduardo just did a very good summary of the temporal evolution in terms of not only CO2 accumulation, but also the damages that we are seeing, especially in countries here in Latin America. I don't know, 20 years ago, we saw much less extreme weather events as we are seeing today. And in the last COP, we saw as one of the main results the loss and damage fund, right, where rich countries should pay or finance poor countries or help poor countries to implement some mitigation and adaptation actions. But this temporal heterogeneity makes that the countries that are rich today, they are already rich, and the poor countries like China or India, they say that they are not willing to pay the current social cost of carbon to mitigate their CO2 emissions, because the other countries, the ones who are rich now, they are guilty of those accumulated emissions, right? And the social cost of carbon was much smaller 10, 20 years ago or 50 years ago when they achieved that development. And also the spatial heterogeneity means that the countries that are facing the damages today are not exactly the ones that are able to pay for the mitigation actions. So the willingness to pay doesn't match with the countries that have money. And that is the problem in the negotiations that we see at the COP, because it's very hard for countries to get a deal on how we can put the money for implement mitigation and adaptation actions in the poorest countries, which are the ones that are more in need of that. So what mechanisms do you see as feasible, maybe in financial markets or even in these kind of conferences among countries, to achieve this huge fund that we need in order to meet the investment requirements in terms of mitigation and adaptation that the world is demanding today? And this question is open for, or maybe Eduardo, you could...
Working in a multilateral development.
I'll help you by gathering a few more questions.
Yeah.
Any other questions from the audience? Yep, Ernesto.
So thank you very much for a great conference. I'd like to look at the bright side, if there is one. So I would like to ask whether there is something good coming out of climate change that we also should expect beside all the worries and that we need to take care of.
Sure.
Anyone else? Please, Max.
So when we think about financing things, we usually think of this as a fiscal kind of problem. Take tax revenues and, do what the federal government does. But I've been trying to think about the central bank's challenge here, right? Usually we sit here talking about inflation. So when we're thinking about global supply chain disruptions that lead to significant increases in prices throughout the world, is that where modeling at the central bank level becomes increasingly interesting? So I'm thinking the folks in Berlin, for example, have this huge web of you take out manufacturing somewhere in Japan and they trickle what happens to prices throughout the world. So it's not a well-phrased question, but I'm just trying to think about what's the specific modeling thing that central banks should be doing given their mandates.
Okay.
All right. So, anyone?
I can do the bright side for a change. I'm not going to do the bright side tomorrow. That's going to be more gloom and doom. But to me, I think there's a few bright points. Maybe highlighting one is the amount we've learned about the benefits of rapid climate action. So doing something about climate change yields much larger benefits than we thought before. These are both sort of direct benefits that we've been talking about. If we reduce CO2, we reduce warming. That has a cascade of benefits. But additionally, the co-benefits, so the quote-unquote co-benefits, we should just call them benefits, but we don't for some reason. We call them co-benefits. Things like changes in air pollution that you also get when you mitigate CO2, those benefits are massive, and they occur right away. We don't have to wait decades. They show up almost immediately in terms of improved health outcomes. And so I think everything we've learned is the things that we need to do for mitigation generate massive, immediate benefits literally for all of us, and to me that's a real bright side of the whole decarbonization effort.
Maybe I'll just throw in a couple of quick ideas. So on the modeling front, I think it's modeling black swan events, whether or not that's supply chains or energy supply or other pieces, or more extreme events by using future RCP climate data, et cetera, is all very important, both for the inflation side but also for the macroeconomic stability side, right? I think those are the two key things on that front. I think on the good side, there are many locations which will actually benefit from slightly warming climate. I think the global geospatial work that's been done on that is actually also a positive side. I think the other positive piece is that if we look at the cost today of changing out our energy infrastructure versus what it was 10 years ago. It's actually a net positive economic impact versus a cost, i.e. the clean technologies are actually almost in every country the cheaper alternatives to develop. They're also more aligned with, I'll call it, domestic resource utilization, increased domestic economic productivity, et cetera. So there's a very positive story within that when all the policies come into play positively on that front. I think on the, just very quickly on, can one get the social cost of carbon right? I think the answer is no. Thanks, Max, for shaking your head. I think the real question is what's the spread on it? What's the range? All the IAMs are, representative of their structures. They're not perfect by any means. And by the way, it may beg the question, should one be thinking about market mechanisms that effectively set the price rather than thinking of a centrally planned pricing structure, i.e. cap and trade system that actually has a lowered cap and no credits given to it, i.e. what the European Union didn't do appropriately 10 or 15 years ago, but is now moving toward.
So let me be very, very brief and try to address two of the questions that were made here. So echoing a little bit on what Marshall was saying, which I fully agree with, I think one important message on the positive side is that, it's very clear now that it's no longer true, it's not true that there is kind of a trade-off between sort of climate change goals and development goals, right? I mean, we are at a stage where good climate policy is also good development policy. So think, for example, of investing in sustainable infrastructure. That's clearly a good adaptation measure for economies that face sort of the challenge of climate change. But it's also good development policy because you want good infrastructure anyway, and sustainable infrastructure, it's proven to be better. So there's no really trade-off. Of course, there are winners and losers. We have to learn the lessons from, say, trade liberalization, and we have to find ways of compensating the losers in ways that make the transition equitable and reduces the political tensions and the opposition to the move towards more resilient economies. On the issue of financing, I think we will have to become very creative in terms of financing mechanisms. And one issue that when we were asked to discuss about the role of central banks that I thought I would say here, and I have the opportunity to mention it now here, is that one example is, for example, this increasing the opportunities for what's called blended finance. So at the IDB, for example, we provide support for green investments via these blended finance mechanisms. That's basically the strategic use of development finance from multiple sources, such as public and private sector entities, to mobilize additional capital towards achieving the sustainable development goals. So this involves combining, for example, concessional funds, which are typically provided by governments in rich countries or international organizations, with commercial financing from private investors, financial institutions, philanthropic organizations, or other donors. So central banks, for example, can think about how to incentivize, I say central banks because this is a conference about central banks, but central banks, international organizations, so on. We can think about how to mobilize and incentivize blended finance towards climate-friendly projects and initiatives in their jurisdictions. So, this is not going to be able to be done with just public money. I think we have a very tight fiscal constraint. We need to find ways of mobilizing financing mechanisms, and these blended finance mechanisms can take various forms, including guarantees, concessional loans, equity investment, technical assistance, risk-sharing arrangements, and so on. We need to be very creative from here on and tap on all these opportunities. That's as much as I can say about that specific topic now.
All right. We are a bit out of time, but I think the conversation has been worth it. And with that, we close today's event, and we resume tomorrow at 9 a.m.